Ethan Harris joins me now. He is the head of North American Economics for Bank of America-Merrill Lynch Global Research. Ethan, welcome to Bloomberg News. Thanks for joining us.
Thank you.
Ethan, tell us what you make of those numbers today. What's the economic data telling you?
Well, it's telling you we're in a very slow recovery out there. We need a lot of help from fiscal and monetary stimulus. Only a few sectors of the economy are actually growing. We saw a little bit of growth in consumer spending, mainly due to the tax support to the auto sector, a little bit of growth in exports, a little bit of growth in federal government. But there's a lot of stimulus measures mixed into that GDP number. Without the stimulus, we'd be in pretty tough shape right now.
Ethan, this isn't a normal recovery, is it? When you look at normal recovery, you're looking at GDP growth maybe 7, 8, 9%, but right now some of the expectations, at least going forward, are for GDP growth between 4 and 5%.
Yeah, so in a normal recovery from a big recession, and this is the biggest recession since in the modern era for the U.S., in a normal recovery, looks like a check mark. It doesn't look like a V. You go from -3% to +7 or 8% in a normal recovery from a big recession. We're looking at growth in the 3 to 3.5% range in the year ahead, so it's actually less than half a normal recovery.
Ethan, you were on Bloomberg Radio, on Bloomberg Surveillance, not too long ago with Tom Keene and Ken Pruitt, and you were discussing the housing market. And you made note of the fact that if the housing market, as you've told us, gives us an indication of how dependent the economy is on government support, government measures, I'm wondering then, does that mean that the government is going to have to increase its stimulative measures to stare down a possible double-dip recession?
I don't think so. I think that what they've done, is, for example, in the housing market by extending the tax credit makes a lot of sense. We're going to go through a pretty choppy period ahead in the housing market as the winter selling season arrives with very few regular homes in the markets and lots of foreclosed properties coming into the market.
Right.
So we need continued help from the government there. But I do believe next year, as the recovery continues and the healing process in the economy continues, we can start to slowly withdraw from these extraordinary fiscal stimuluses.
Was that Case-Shiller information that came out today showing that home prices in 20 U.S. cities rose for a fourth straight month in September? Does that give you some hope?
Yeah, I mean, what the recent housing data tell us is that there's some bottom feeders coming into the housing market willing to buy at these very depressed prices. It's also showing some of the benefits of the tax credit for home buyers, which of course is only a temporary stimulus. My concern going forward is, again, as you go into the winter season, most of the houses for sale are going to be foreclosed properties, and they're going to be at pretty distressed prices. So I don't think we're going to see those same kind of price gains into the winter. I think a sustained, strong recovery in home prices is probably a year, maybe 2 years away.
Ethan, are consumers ready to jump back in the fray, or are they tentative because of this jobless numbers? And parenthetically, if not consumers, is corporate spending going to lead us out of this?
It's hard to see a leader for the economy right now. You have a lot of little pieces that look better. Certainly exports will be strong. Federal government spending due to all those programs will be strong. Companies aren't cutting their inventories as fast. That will help out. But none of these are going to take on the leadership quality you hope for with a robust recovery. The consumer's going to lag. In the fourth quarter, we're expecting consumer spending growth to be only about 0.8%. So without the cash for clunkers boost, we go back to a very anemic consumer. And that's likely to continue going forward.
When did we get past all of this? What's the sign that's going to tell you and other economists that we are past this? Will it possibly be when the Fed raises rates?
Yeah, I mean, I think of the economy as being in rehab after a tremendous auto accident. And so we're looking for signs along the way of improvement in the patient, that wounds are being healed. I think the first step is for the job market to turn positive. I think that happens early next year. The next steps are the banks starting to feel better about their capital positions and starting to go out and lend again. Consumers feeling a little bit better about their balance sheet, willing to spend a little more. There's kind of a long-term a healing process that plays out over the next year and a half. By the time the Fed hikes interest rates, that will be a signal that the Fed has seen that healing process succeed, and they're ready to, in a sense, release the patient from the hospital and try to start normalizing life again. I don't think that happens till the first quarter of 2011.
Any thoughts on comments today from FDIC Chair Sheila Bair?
Well, I mean, the banking system still has a lot of headwinds, and certainly there are a lot of bad loan issues for regional banks. It's a tough slog out there.
Ethan, Fed minutes are going to be released today. Are you expecting any surprises?
No, I think that the Fed actually is kind of in a fairly comfortable equilibrium right now. There's the usual kind of hawk versus dove debate going on, but I think the committee as a whole is united in this idea that they're not thinking about raising interest rates anytime soon. A real debate will probably ensue later in the year as we see more signs of improvement in the economy as we get later into 2010. But in the next 6 months or so, I think that they're pretty much all in the same playbook.
And Ethan, I might want to mention, just get your thoughts quickly in about 15 seconds, at that presser at the White House, the Indian Prime Minister Manmohan Singh saying that India and the U.S. will intensify trade to stimulate jobs.
Yeah, I mean, trade, it's important. Trade is a big driver of global growth. The worst thing to happen would be protectionism right now. We need to encourage global trade. It's a big engine of global growth.
Ethan Harris of Bank of America-Merrill Lynch Global Research joining us to talk about the economy and today's data that came out. Ethan, thank you so much. We appreciate it.
Thank you.